wrong, feel free to stop me. That sometimes happens. All right. So first to start, let's just catch up on what we were doing last time. So last time we figured out the Twitter purchase price is 44 billion, and that we're paying whatever transaction fees, fines, and fees. We figured out the debt, how much that's going to cost. They're basically like 4 layers of debt, and then finally we kind of just talked about the income statement, and we decided that basically revenue is probably going to fall a bunch. This is sort of based on their projected revenue. The 1 quarter they announced. And so we just extrapolated that for the whole year. And then we decided that they're going to be flat in 2023, and that they're gradually going to kind of return to maybe about 20% growth over time. With the cost of goods sold, we did assume some cost reductions from the labor, the layoffs, and basically that was kind of related to the number of people that they're going to lay off, and at kind of an estimated salary. We said an average salary of 117K. So we're saving about if 556 million on the salary. So you kind of see that cost reduction here, where it goes from 2 billion to about 1.6 billion. And that margin continues to sort of improve over time. But even with this margin increase, it's really not enough to account for the loss in revenue that they've been experiencing with advertisers bailing, also the tougher economic environment. So that's kind of where we're at, and we kind of got down to EBITDA. So now we're just going to finish the rest of the model, or we'll see how far we can get. But the goal is to get the cash flow statement, balance sheet going as well. Great. And before I continue, can everybody know, just let me know if like they can't hear me or something like that, or if they can't see my screen, anything like that. Just either say it verbally or say it in chat. Sometimes I'm not like super great at looking at chat, so feel free to.
And can see everything.
Okay, perfect. Thank you. Because I remember last time I like streamed for like 5 minutes without actually sharing my screen. It's just real fun. Awesome. And I'm gonna try to get this in a way where I can see everything. So chat. Okay, there we go. So I got chat open here. Okay, awesome. So now I can see everything. Great. Okay, let's keep going. So let's just go step by step down to net income. So we got depreciation here. Depreciation's honestly pretty boring. It's just percentage of assets usually, or percentage of beginning PP&E, or it can be percentage of sales. So we can forecast that either way. I think let's just do this properly since we're doing it. So we actually need to kind of create a PP&E schedule to do depreciation. So let's just skip that for now. By the time we get down to PP&E, we can do that. First, I'm just going to fill out the rest of this. And let me see what's over here. Oh yeah, this is just a bunch of one-time costs. So we're going to assume are 0 going forward. We'll get down to net income. And what would be interesting is seeing what their effective the income tax rate that they're paying is. So it's not always like exactly 20, like it should just be around 26%, but it's all over the place. In some years they're like, because there's just a bunch of tax credits going on. So usually when this happens, we just assume the marginal tax rate, which is just going to be 26% going forward. And I don't think I have, I'll just put it here. So 26%. So 21% is a federal, and 5% is the state usually. Of course, they also have operations around the world, but we're just going to simplify it like that. And depending on how what happens with Biden and stuff, that corporate tax rate may change. We'll see. Okay, so we have the income tax expense. Let me just fix this formula. And we have net income. So net income is the first item in the cash flow statement. So the last item of the previous statement is always the first item in the next statement, which is kind of nice how it flows. So we're gonna have operating activities in the cash flow statement, and then investing activities, and then financing activities. And the most important are the first two, actually, because the first two, operating, investing, they're going to make up what's called cash flow, or like free cash flow, basically. I like to call it free cash flow available for debt repayment, which is exactly what it sounds like. This is probably the most important line in your LBO. And we're going to see how it's calculated in a second. So with operating activities, you start with net income, as I mentioned. That's like the first item, which is the last item of that income statement. And we're actually, yeah. So, and then what happens here? We're going to add back depreciation, and we're also going to add back amortization goodwill. So I'm just going to put it all in here in one line. So that's pretty straightforward. We'll just take this D&A, we'll add it back. I haven't forecasted it yet, so we're going to have to see what it is in the future. But for now, we'll just leave it like so. And then the other thing we have to do is add back any PIK interest. So if we take a look at the debt here, is there any PIK? PIK is basically payment in kind, which is interest that is not paid in cash. It's like you kick the can down the road, you pay it later. But from what I can tell, there actually is no payment in kind. This is all cash. I think the lenders, frankly, don't want to take any deferred interest because they're probably afraid that Twitter is not going to pay it. The fact that Twitter made headlines simply for paying their first interest payment of 300 million was just like showing you how uncertain the market is that they're even going to pay their interest. So yeah, there's no kind of deferred interest. It's kind of like a line of credit where you don't pay the interest, you just pay it later, and your debt balance just keeps going higher and higher, like a credit card out of control kind of thing. But we don't have to worry about that. So there's no PIK interest. Next, it would be the networking capital. So this is the interesting thing about doing a cash flow statement. You often do it in tandem with the balance sheet. Why is that? Because for me to get the networking capital, I kind of have to create a networking capital schedule, which would go into the balance sheet anyway. So why don't we do that right now? We'll create a networking capital schedule. So what networking capital is, first of all, the definition of it is this represents your like the asset, the kind of the current assets and current liabilities that you use to run your business. So it does include things like cash or deferred tax assets, but it does include things like accounts receivable, includes things like inventory, accounts payable, things like that. And actually, why don't we take a look at what Twitter has for their networking capital. So I see accounts payable here. So I'm going to put this in the balance sheet here. So we're kind of doing the balance sheet and cash flow statement at the same time, which is pretty normal. So we'll have cash and cash equivalents. We're going to have accounts receivable. I'm going to just treat the short-term investments just like cash, because realistically, these can be sold. These are investments that can be sold within 3 months. And so they're kind of like cash. Accounts receivable, so like stocks and stuff. Accounts receivable is money that their clients owe them. And then we have prepaid expenses. They have restricted cash, which is interesting. I'll leave it there. Sure, restricted cash. And then that's just cash that they can't actually use because it's being saved for like maybe like a lawsuit or like just something that requires them to hold on to it. Or maybe it's like collateral for something. Let me just freeze the frames here so you can see everything. Cool. So we got sorry, this would be prepaid expenses. Oh, sorry, this is the wrong thing. Here we go. Okay. Other current assets. So that's a total current assets. I'm actually not going to, actually, no, we'll separate it. You don't have to separate it between current and non-current. Current assets just mean it's like lower than a year in terms of its lifespan. Non-current is longer than a year. It's just not really complete necessary to separate them, but we'll do it anyway. Okay, so then we have, here's what I want to see. PP&E, that's important because it's going to drive our depreciation. I don't care about this accumulated depreciation. Like this is just accounting mumbo jumbo. I just care about the net book value because that's what it's actually worth after it's depreciated. And then I'm going to have a long-term investments goodwill. Here, I'm just going to copy this instead of typing it. Cool. So yeah, whenever you're looking at public statements, you got to just kind of like think about like what you want to put in, what you want to maybe just combine or simplify. And you have total non-current assets here. And then we can get a total assets number. Save this up real quick. Okay, so I can take a lot of this historical info and just dump it in. So we're going to take all this info here. Accounts receivable. Prepaid, restricted, and other current assets. I'm using the shortcut Alt ESL, by the way, which is paste link. Really great shortcut. Special paste is probably the most useful shortcut in Excel. And to do special paste, just Alt ES, and then you can select the thing you want. It's always good to check as you go to, like, so for example, that matches, these all match, right? So, and then a good check would just to check my total assets, make sure that it matches with what's there, and it does. Cool. Okay, so that's our balance sheet historically, and then, and after I do this, I will have my net working capital items that I need, and then we can continue with the net working capital schedule, and then continue with the cash flow statement. Some people will just choose to completely do the balance sheet first before the cash flow statement, and that's fine too. There's no like right way. I like to have the cash flow statement above the balance sheet though, because of kind of how I mentioned how it flows, but okay, and then so these ones I'm just copying as is because it kind of works out that way. That current portion of long, it's kind of annoying. One annoying thing I find in accounting is how they separate the current and non-current stuff. It's like I'd rather just have these combined, but just for the sake of time, I'm not gonna like try to calculate what the total is. It's like in accounting, they need to show which one is due in a year and which one is not. And that's pretty much just for creditors, to be honest. Curious if this always does this. This is actually worth 0, or is that a Capital IQ being like, yeah, see, Capital IQ does a really annoying thing where it doesn't actually have a 0 value. It just puts a dash. So you literally have to like replace it with a 0 so your model doesn't get confused. But yeah, the reason accountants separate long-term and non-current or current and non-current is for the creditors. The creditors are actually care about what's due in a year, what's not, but we're not a creditor. And the thing is, that's actually going to get wiped out anyway. So it kind of doesn't matter. Because in an LBO, we are going to just replace their debt with our own anyway, right? So this is just sort of, but it's, since it's here, I might as well just copy it. Okay, here's one thing about an LBO. With public companies, they often break out their shares equity in like a bunch of lines, right? Like, and in a PE firm, we don't care because that's useful as a private or public company. Maybe like, maybe I want to see, what their, how much money they raised through like equity issuances, which is the paid in capital. And maybe I want to see how much money they've accumulated through their net income, which is negative. But as a P investor, it's just like easier to just like, this is going to get wiped out anyway, right? So because we're going to wipe out their shares equity when we buy it and put in our new one. So it's easier to combine this into one line for PE. Okay, so now the final step is just to find the sum of those things. I'm just gonna do a mic check quick, make sure. Yeah, I have the right mic. Okay, cool. Cool, and then we can do a check. Always good to have a check. This should always balance. Total liabilities plus shares equity equals total assets. Why? Because your assets have to come from somewhere, right? And they're going to come from the money you raised, which is this side, the liability shares equity. Okay, so that's historical balance sheet. So now we can start building the net working capital schedule. So the net working capital schedule, it's over here on the right side of the sheet. Let me just grab my iced tea real quick. Big fan of iced tea. Because you don't have to heat it. Nobody's got time to heat things these days. Okay, accounts receivable. Oops. Dropping things right now. Okay, accounts receivable is the most common form of net working capital. It's like, you know, your customers, Twitter's clients. Who are Twitter's clients? Big, you know, big companies, advertisers. They're not going to pay them right away. So that's why we have accounts receivable. We have prepaid expense. We don't have inventory actually, which makes sense. That would be more of like a retail company. We do have prepaid expenses, which is when you like pay up front for something like insurance. So obviously Twitter is going to be paying for things like insurance. And usually you pay up front for the year, but you don't like accounting. Basically, you're only supposed to expense things when they're recognized. So when their service is actually received. So when you prepay, you basically get an asset until it is actually expense, and then the asset goes down. For accounts payable, let me just see if there's any. Oh yeah, other current assets is another. So usually for net working capital, it's like accounts receivable, inventory, if any, prepaid expenses, if any, and then other current assets is also very common. And then you get your total. These are your operating current assets. Not like I don't want cash in there. Cash is not necessary to run a business. I mean, like, you know what I mean? Like it's not necessary for the daily operation of the business, but accounts receivable is often because, you know, it's a standard to not accept cash right away. Prepaid expenses is part of the daily operation. It's in there. On the liability side, it's going to be accounts payable, accrued expenses. I don't want anything interest bearing, right? Interest bearing, no, that's not net working capital. That's debt. So long-term debt, leases, no, that's debt. Income tax, that's a tax thing. That's not operational. Unearned revenue is an interesting one. If it's recurring and it's part of the core business, then you do need to put it into net working capital. If it's a one-time thing, you might just exclude it because it's like, you know, it's not like a normal thing. Maybe just this one time it happened that somebody paid up front for your service. But with Twitter, there are subscriptions, right, that people can pay for, especially these days with the new $8 per month plan, Twitter Blue or whatever it's called. That's out now. So yes, this is part of the business. This represents customers paying upfront for subscriptions, but you cannot recognize a revenue until the service has been delivered. So basically, as time passes, you get to recognize more and more of this, and eventually, you'll recognize the full amount of revenue, and it will go down to zero. But of course, because there's new subscriptions, upfront subscriptions every year, it probably actually goes up over time because as your revenue goes up. So I'm going through this pretty quick, but I just, you know, don't want to like bore people with, you know, because modeling takes a while. It always takes longer than you think. One of the scariest questions at work is like, how long do you think this will take? And you always have to underestimate because it always takes longer than you think for some reason. There's always some hiccup. Okay, so, I do need to paste in the other current assets. So while I'm talking here, I kind of forgot to do that, but that is in there. So if I just do a quick check, seems like everything's all in there. Accounts payable, accrued expenses, unearned revenue, other current liabilities. Cool. And then we can just calculate net working capital. This represents the value of our, like how much cash in total is tied up in just sort of kind of running our day-to-day business. And the change in net working capital is the cash that's tied up every year. And I'm actually going to take last year minus this year. Why? Because basically, if net working capital goes up, that means more assets, more cash is being caught up in the assets, which means that we're actually putting more money into the business. Because as assets go up, our cash goes down. If people owe us more money, our cash goes down. If we have more prepaid expenses, that means we're paying for those and our cash goes down. And it's the other way around liabilities, because if liabilities go up, well, that means we owe people more money So the money that seems like it's expense in COGS, well, some of that wasn't actually paid in cash yet because we are going to pay them later. So anytime we can pay somebody later, it's going to save us cash. So that's why I'm going to take last year minus this year, because of the fact that assets are actually bad for cash, and if they go up, I mean, cool. So that's change in working capital. Now, if I want to forecast this, how do I do that? I'm going to take revenue COGS here. This is one of those things that people get really confused about. And I'm going to do it in a way, hopefully, that makes it easier to understand. So first, I'm just going to revenue COGS, because those are the main drivers of net working capital. And I'm going to put in some metrics here. So I'm going to have AR days, accounts receivable days, prepaid expenses. Let me just copy this, save time. And then I'll copy these ones over. So these are going to be our drivers. Some of these will be percentage of sales. And how do I know which ones are going to be percentage of sales? Well, there's really only 3 that are not. It's accounts payable days. So anything to do with accounts receivable or accounts payable, it's better to use it as like a days metric. Whereas everything else can be a percentage of sales. And then one thing I noticed is that their unearned revenue, they have a current, right? Which means that there must be a long-term. Actually, there isn't. So it's kind of redundant. They said current. There's only current unearned revenue. So I was just curious about that, but whatever. We'll leave it just because it's there. Okay, so and it's back to what I was saying. So why don't we do the easy stuff first? So prepaid expenses percentage of sales. It's pretty straightforward, right? Take prepaid expenses divided by sales. Makes sense that it's driven by sales, because I mean, you could drive it also percentage of something else, but oh, sorry, this should be. So yeah, it was really high like this year. That was like 5 years ago. Most recently, it's 3.1%. And, you know, it was also 3.1% in 2020. So we can make that constant. In most models, PE, hedge funds, whatever it is, we often just take it the most recent year for net working capital, because it's not the most important assumption in the world usually. And to save some time, what I'm going to do is lock the revenue line here. Oops, sorry, I didn't mean to do that. So notice I locked the row. Very good to use that, because now what I can do is just drag this down, and it'll just automatically divide the current assets with the revenue, saving me a bit of time there. Accounts payable, I can take that divided by, actually we're going to skip the day stuff because it's more complicated. Well, first we're going to do accrued expenses divided by COGS, and what's going to lock the row, saving a bit of time, because if I can just tell Excel like, hey, just take that one row, 197 COGS, everything will be easier. And once again, I can just, you know, make it all equal to the previous year. It's always good to double check to make sure it makes sense. Like here, for example, accrued expenses kind of going down, right? A little bit last 12 months. It's percentage of sales, and that's, or percentage of, sorry, I made this percentage of COGS for some reason. My apologies. I should make this percentage of sales. I don't know why I did that. I'm probably talking too much as I model, but to be fair, that's the whole point of this. Okay. Yeah, that makes more. Okay. But my point still stands, is that this goes down a percentage of sales. But to be fair, it was around 10% in those few years. So I feel like maybe it was just abnormally high during the pandemic. So I think that's fine. So I'm okay with keeping that. This is a little higher than usual unearned revenue, but that's also because they because they've changed their business model. I don't think LTM June would have reflected that change yet with the subscription model they're doing. But to be fair, it would be higher anyway. So I think having that higher is good to represent the, you know, the new Twitter plan and all that stuff. And then this is super minuscule. It doesn't really matter. Oh, it's 0 anyway. So it's, I don't even know why we have this line, but it's whatever, we'll leave it. Cool. Okay. So now I can just, why don't we forecast those ones? Because these are the easy, this is like, you know, the easy stuff. And then we'll get into the ones that require days calculations. So if I take revenue, multiply by the percentage of prepaid expenses here. Oh, sorry, that should be over here. We'll do the rest as well. Lock the revenue row, which is the 196. So I can just bring it down. And then accounts payable, or accrued expenses will be percentage of sales times revenue as well. Lock that. Lock the row there. Okay, cool. So that seems to all work. Now let's go on and do, just gonna switch to my standing desk for a second, and we'll go on and do my Samson buds keep falling my ears. I have big ears. Not that you need to know that, but I'm buying larger Bluetooth headphones. Okay. Okay, so next step is the accounts receivable, accounts payable. So how does this work? I'm just gonna just double check. I don't see any questions in chat right now, so things are seem pretty chill. Okay, so accounts receivable days. People always get confused about this. They're like, I don't get it. What does this mean? This is the number of days it takes for a client to pay you. And you can think about it like this, right? If I did, let's say I did accounts receivable as a percentage of sales. And you could drive your model like this. You could just be like accounts receivable divided by sales. And this shows me what? What does this tell me, really? This tells me like in a year, how much of my revenue is in accounts receivable, right? Because this is annual revenue. So if I know that, let's say in LTM June, like 19% of my revenue is accounts receivable, that means that for 19% of the year, I'm like waiting for cash from my client, right? Because if so, in other words, if I'm waiting 19% of the year, for people owe me like 970 million. This is how much I'm getting in a year. Well, how much is that in days? Well, we're just going to take that and multiply by 365, right? And so what does this mean? This means it takes 68 days for Twitter's customers to pay them as of last 12 months due. It took longer before. So it seems like they maybe tightened on their policy. The pandemic was the worst, makes sense. Everybody was, but yeah, they've tightened their policies so that it's a useful stat. And going forward, we're just going to assume the same days. Now, if you want, you can even, most people don't do this, but I think lately I've been doing this more because it's kind of just more intuitive. You can actually just drive it on a percentage of sales because it is technically like easier to do it. You don't have, it's like less math. So you can just do this, right? And then you can just figure out what the equivalent days is. You could also calculate it, by taking this times 365. If you wanted to do it like the way that most people do it, which is just a bit more math, you can do, basically accounts receivable days. First, you take the percentage, you could take the revenue times accounts receivable days divided by 365, right? Which is just the formula. It's harder to remember that formula, but and instead of doing this, I could also say, accounts receivable divided by revenue, the percentage of the year that's revenue, times 365. But I remember when I was learning this, I found it hard to remember that formula. So, feel free to do it this way because it's literally going to get you the same answer. Because so let me just turn on circuit references. It's going to get you the exact same answer. The days thing just is an extra step. It just shows you, the viewer, how many days it takes for the customer to pay, which is a useful metric, right? Because maybe it's really high, maybe it's really low. You want to know how long your customers are taking. Maybe you can improve that when you take over the business. Accounts payable is the same thing, except instead of sales, it's going to be percentage of COGS. So I'm going to make this percentage of COGS, and I'm going to do it this way. I kind of like doing it this way now because it's so much easier to explain. People always look at me like I'm crazy when I try to explain this the other way. So let's just do percentage of COGS, right? Why percentage of COGS? Because you are paying for your cost of goods sold in credit, and accounts payable represents the amount of you owe relative to that COGS number. So we're saying that about 7.5% of our annual COGS is in accounts payable, meaning that 7.5% of the year we're waiting, or our suppliers, our vendors are waiting for us to pay them. And what's 7.5% of a year? We'll just take 7.5% and multiply that by 365. So this way is a bit easier because it's really just the days becomes an output rather than input, and the input is actually the percentage of sales and COGS. So we can keep going here. Percentage of COGS, accounts payable times our COGS itself. And as you can see, our COGS goes down this year, so our accounts payable actually goes down as well. That's from the layoffs of 3,700 people. So, okay, so that's an working capital schedule. That was, and if that's reviewed, that might have been boring, but I know a lot of folks struggle to understand that, so I just wanted to explain it fully. It seems like a lot of work just to get net working capital, and it is, but unfortunately, it is a necessary part of modeling. There are some businesses where net working capital is actually important, like really random industry, but HVAC, where sometimes customers take the 60 to 90 days to pay you. HVAC's like air conditioning, heating and stuff, like very industrial type B2B businesses, like customers can take forever to pay you. It's funny, like the larger the client, the longer they take to pay sometimes, especially with industrial manufacturing. For now, the way I like to do is I actually like to list every single thing and then just put changes. Why? Because because then I can actually see how much money is being tied up for each of these items. So yeah, you could just have this all as changes in working capital, but I actually like to do this. And then I can, I usually tie it to the balance sheet. So actually, why don't we go to the balance sheet first? We forecasted all these things. We can just link them now in. So accounts receivable, we can link in. It's just going to go here. Prepaid expenses, same thing. Same with the other current assets. Restricted cash, I don't even like, let's just keep that constant. I'm going to fill that out later, actually. And so we are doing, we're doing this deal as of LTM June. And the way I'm going to do this is I will do that, and then I'll probably have to forecast half. So I'm going to have to adjust this, right? You have to adjust the balance sheet. So this will actually change later. And then we'll have to project half a year and then do the rest, do the other 5 years. And we're going to assume 5.5 years. Holding, like I could also make this year 1, year 2, year 3. That might be easier actually. So that's probably what I'll do. So that we don't have to do a stub period, because we're probably going to sell in 5 years anyway. We're going to assume that Elon Musk is like a LBO, like a PE fund, just for simplicity, to see what it looks like. He may obviously hold it for much longer than that. Okay, so let's keep, I might be talking too much today, but I feel like it's better to talk than not talk. So let's just keep pasting things in. Like, because I could just like laser through this, but then like I feel like a lot of people wouldn't know what I'm actually doing. So I think I'd rather talk. Okay, so we got the net working capital in. Great. So that fills out some of the balance sheet, and it helps us fill out this part of the cash flow statement, which and by the way, I'm not going to actually do the historical cash flow statement. And most PE funds, they won't actually get you to do it because it's just unnecessary and frankly annoying sometimes. Because if you look at the actual cash flow statement, it's like, oh my God, look at all this stuff. Like I don't want to, like a lot of this stuff is not going to apply to me. But I am going to go through it to make sure that we capture key things. So but some of this won't apply to us. Like I don't think, actually this is not the worst cash flow statement in the world, but like the foreign exchange rate adjustment, we're not going to do that. It's not our business to like predict where the US dollar is going to be in 5 years. Okay, so change accounts receivable, that's pretty straightforward. If accounts receivable goes up, what happens? By the way, I'm going to change this just so we're clear that this is now going to be year 1, year 2, year 3, year 4, year 5. So this will, one easy way to do this is if you go formatting, you go to type, rather than just typing year 1, I can actually go, I'm going to get rid of the E actually. We don't need that. We'll just say year, like see the apostrophe. The apostrophe means put in this text, right? So bam, year. So now so this represents like June 30th, basically 2022, 3. And I could even put in the date just for clarity. There's another function which you don't necessarily need to know, but you can use the date function and it will, I don't know if it's actually going to save time, but actually, I want to just, sometimes it's just easier to, it's a useful function, the date function, you can look it up, but I think in this situation, it's actually faster to type it. Okay. Cool. Okay, changes accounts receivable. So as I was saying, accounts receivable is going to change. Why some of these decimals? That's annoying to me. Sorry, I don't know why my shortcuts are still not working. It's very strange. Okay, well, looks like one of my favorite shortcuts stopped working. So that's fine. But let me just ignore the formatting for now. We can fix the decimals later. Let's just get back to what I was doing. Change accounts receivable. It's going to be last year minus this year. So an increase is going to be bad for cash flow. Decrease is good. We actually have a decrease here. Why? Because we're making less money. So there's less credit. Okay, prepaid expense, the same thing. Asset last year minus this year. Change other current assets, same thing. Anytime asset goes up, bad. Goes down, good for cash flow. Accounts payable. If it goes up, it's actually good. So we're gonna pay this year minus last year. So liabilities is the opposite. Once again, our liabilities is going down. So the opposite of what happens is happening because of the fact that we're like losing revenue the first year, and therefore some of our also costs are going down due to that, but also because of layoffs. Same with unearned revenue. So this is cash that we're not actually getting. And then other current liabilities, same thing, except it's just zero anyway. So it's kind of pointless to put that in there. And as a check, it's good to just like, if I add up all my change net working capital, minus 71, I go to like my net working capital schedule, minus 71. See, we're matched. Always good to check as you go, because you don't want to like do a bunch of stuff and to be wrong. Especially then when your balance sheet doesn't bounce, then you just want to like die. Not actually though. There are actually ways to get around balance sheet not bouncing. And if God forbid my balance sheet doesn't bounce, it'll be a good time to show you how to deal with that. Okay, so next would be to do the investing activities, which if I take a look at what it is historically, like, they have some capital expenditures. That's like the most common, which is just spending money on assets. Oh, by the way, random thing, but feel free to just as a favor, if you don't mind going to my YouTube link, I'll just put it in chat just so I can increase the number of viewers. I put it in the Zoom chat. You can just click on it and mute it so you don't have like double audio going on. If you could do that, I really appreciate it. Thank you. Because yeah, it helps boost the viewers, which is good for everybody, good for Apex too. Okay, so capital expenditures, as I was saying, represents this. I'm actually going to post in the historical because I want to see like what it's been historically as a percentage of sales, right? Like, so I can predict the future. There are different ways to project it. And you're going to notice I'm like, when you're actually doing this for like an actual firm, you don't want to do what I'm doing here, but I'm also trying to save timer. So I'm actually just going to calculate the percentage here, but you might want to calculate in your PP&E schedule. Actually, you know what? We are probably going to make a PP&E schedule. So why don't I actually not hack it for once and make a PP&E schedule? I think it might be worth to make one. It's worth it to make one if you're going to forecast depreciation like properly, which is as a percentage of PP&E rather than as a percentage of sales. And I think we're going to do that just because I'd rather for this show you guys just like, how it's actually done in real life in PEP. So you're going to have your beginning PP&E, you're going to add your CapEx, you're going to subtract your depreciation, amortization, or just depreciation, I guess. And then you're going to have your ending PP&E. And that's what a PP&E schedule is. And like basically what I'm gonna do here is I'm gonna link this CapEx over here, but make it positive because CapEx is gonna actually increase our PP&E. And I will be able to see, and we're gonna start it from 2018 because we don't have 2016. And so basically my PP&E here, I know it, so I can link it here. This is my ending PP&E. And then my beginning for 2018 is going to be my ending for 2017. So I can see, and hopefully this lines up. Oftentimes it doesn't, and then but I'm curious if it does. So in my income statement historically, I have the depreciation, I think. No, I don't. Never mind. I have it in the cash flow. You know what? I guarantee it's not going to line up because accounting, for some reason, they just never make it in a way that's easy for financial modeling. Yeah, see, it's always off by a little bit, right? So It's off, but not off by a lot, but that's probably because in this DNA number, they have some like random other stuff that's not the PP&E or whatever. But that's fine because we can actually just imply it. Now this may or may not be worth it, to be honest. If I just look at the difference, it's actually significant in some parts. But then the problem is then we have to figure out where the other amort goes, and it gets kind of complicated. And so I think for this actually, because sometimes you got to make a decision because things are lining up, it might be easier to make depreciation DNA as percentage of sales rather than trying to get an exact amount. But I want to show you how it works. Basically, the way it works, if we were to do it this way, let's just pretend this depreciation number was actually worked. Like it would just be like whatever would make this work. So yeah, like that, because these are fixed numbers. So then I would just figure out the depreciation as a percentage of the beginning balance, and that would be the whole point. And then you would just carry that forward, and then going forward, you would just take 18% times the beginning balance, and you'd have your capex driven percent of revenue. Once again, we're not going to do that because, as is often the case with public financials, they did not break out depreciation specifically for PP&E. And although we could back solve it and then put the amort somewhere else, you have to ask yourself, why are we doing this? Is it just to make it look better? Yes. Does it actually change the answer? No. So let's simplify things. And we're going to simplify by making DNA's percentage of sales, basically, is what I'm trying to get at. So I'm going to go back to what I was going to do, percentage of revenue, and take the capex divided by the revenue and get like a sort of a percentage here. And then we can take that and multiply by revenue to kind of have it forecast it going forward. And this is the time in the stream where I make a quick trip to my fridge. Give me 15 seconds. Right back. See, that was less than 15 seconds. It's really good working close to your fridge. Because then I drink these Soylents and they're great for getting some, quote unquote food, but some people don't call it food. I actually like them. Anyway, that's not related to mauling. Let's go back to mauling. CapEx. So I just forecasted CapEx. Okay, so what was the whole point of this? The whole point of this was to find this magic number. Free cash flow available for debt repayment. It is the most important number in your LBO because this is like what your business is making in terms of cash. And this is the cash that you can use to pay back your debt. These numbers don't look great, do they? Look at that big negative. Based on this, is Elon paying back debt? Probably not. Now, I haven't filled in some things, to be fair. I still got to fill in the DNA, but the DNA isn't really going to change that much. It's just going to help them reduce their tax a bit. Why don't we actually do DNA? Because let's just, it's right here. As I mentioned, we're going to do percent of revenue. Totally fine in the situation, given the limited data that we have. And we can kind of just figure out what DNA has been as a percent of revenue. This amort line is zero. It's kind of weird because it's zero. I mean, it's fine. I already talked about this in the last session. Sometimes you got to just work with what you got. And we're going to make it constant. Does that make sense? Yeah, it does, because it's like around 9 historically, right? So, and I'm not going to worry about this. Like, we are going to have to amortize the financing fees later. So I think what I'm going to do is drive it by, so right now, for the forecast, I'm going to drive this by percentage of sales. Is kind of what I'm saying. And then the amort it might change because we may have to amortize our financing fees. And I'll explain why financing fees are amortized later, but it's just, well, it's because they represent the debt, and then the debt has a lifespan of 5 or whatever, how many years. So you spread the expense over 5 years, basically, through amortization. We can do that later, but for now, let's just have this depreciation in. That's being added back here, right? And that will help them reduce their tax slightly, but it's not like anything crazy. Their cash flow, guess what, is still pretty darn negative. Cool. Okay, so They did save some tax, actually. That's a decent amount of DNA. Okay, so we improved our cash flow slightly by adding the DNA. I mean, why don't we just go all the way, see if it's any better if we give them their and this is before I've even put in the interest, by the way. Okay, so this is like their actual cash flow is going to be lower, just so you know. But let's give them the their financing fees and what are their financing fees? It should be in our source and uses like 313. Yeah, that's nothing crazy, right? That's like if we assume a 5-year life, which is pretty normal. It's usually 5 to 10 years. So this financing fee divided by 5, right, is like going to be the amort. Gives them a little bit more tax savings. Maybe they save another $10, $20 of tax. Yep, their cash flow still sucks. What do you know? Okay. Great. And this is before even the interest. Now, I have built a somewhat slightly pessimistic scenario for our good friend Elon. Okay, so there's a bunch of finance activities. Let's jump into those later because I don't want to confuse you guys. I want to jump into the good stuff, which is the debt schedule. This is now we're getting kind of to the more, actually, no, before we can do that, why don't we adjust the balance sheet? So it goes, in case you're wondering, assumptions, sources and uses, income statement, cash flow statement, balance sheet, you kind of do together a little bit and you do the net working capital schedule. But you have to leave the finance activities kind of blank because to do that, you need the debt schedule. And then this is probably a good time to adjust the balance sheet. So I'm going to save this up. Technically, you can actually do an LBO without a balance sheet. So you could actually, if you're in a rush, you're doing a case study, you could actually do this later. Like this doesn't really change anything, to be honest. It just like makes your balance sheet look nice. And, most investors are going to want to see a balance sheet, like just so they know, and they know that you can make one and that it works. But it literally drives nothing. Okay, so pre-transaction balance sheet basically is what we're going to have. We're going to say pre-transaction. So this is going to be the balance sheet for LTM June, or not even LTM, sorry, just June 30th, 2023. This is the transaction date. We're assuming. I forget the exact date that he bought it at, but like let's just say it's around then. Like he bought it after that, I know, but like in terms of the financials that are available, like that's probably the closest we got. Actually, let me just double check because I don't want to be completely wrong here. Whoops, didn't mean to open that. Twitter, LBO, Musk. I know I saw this before, right? Yeah, it was like October. So technically Q3 was out, but I don't even have Q3. Like we only have June 30th. So let's just work with what we got. Pre-transaction is just basically going to be this. Okay, so everything I have here is now going to be over here. This is what it looked like before the deal happened. So I'm just gonna, I wish there was I remember there used to be this shortcut that allowed you to like copy formulas, special paste formulas. I think it was like a Calc IQ shortcut, but I haven't figured out how to get the plugin working on my computer for some reason. So I'm gonna have to just do this. Where I'm literally just manually copying the formulas one by one. Good old investment banking days. They had all the macros set up, so you didn't have to do stuff like this. So yeah, I'm just, some of this I could probably just drag down, I think, right? Yeah, okay. So that I probably should have just done that earlier. I don't know why I was doing that. Oh look, my shortcut finally started working again. Okay, so as you can see, this is literally just the balance sheet from over there. I'm just moving it here. Oops, sorry. Actually, what I could have done, I just realized maybe saving me time, is just Control X it over. Because I don't think this actually drives anything. Oh, maybe it does. Maybe that's why I didn't want to do that. Okay, yeah. So it may be more efficient perhaps to adjust your balance sheet first. I don't know. Before you even, I haven't really thought about that. This is just the way I've normally done it, but now I think about it. Reason I adjusted later is because I feel like it's not the most important thing. Like if you were jammed, you could technically just not do it. Okay, long-term debt. So this is just what they had before. Yeah, same thing. I think, I don't know if I can just paste this down. I can't remember. Oh, I can. Okay, sweet. Okay, so that was a little bit of boredom, but we finally got this balance sheet on the pre-transaction thing. So what am I doing here? I'm basically trying to figure out how to go from the pre-transaction before the deal to what the balance sheet looks like after we do the deal. And they will not be the exact same because some things will change. Some things will stay the same. Most things will actually stay the same, but things like the debt, the shareholders' equity, that's going to change because we got a new owner now. We got Big Boy Musk, who is the owner. No longer do the public markets, do the people own this company? Not really the people, the shareholders. I mean, is now pretty much Elon Musk. And one day the banks, perhaps, when he goes bankrupt. Just kidding. I mean, maybe I'm not. Okay, adjustments plus. I hope I highly doubt Elon Musk would ever watch this, but if he's watching, don't fire me. Okay. So adjustments plus minus. Okay, so what am I doing here? I like to have two adjustment columns for this because some people do it all in one column. It's easier to make mistakes. If you have two columns, you can see what you're subtracting, what you're adding. So what are the steps? Well, at first, let's get rid of our, we know that the public shareholders no longer own this. Why don't we just get rid of them? Let's say goodbye to them. I'm going to freeze the frame here. So you could, wait, that didn't, yeah, okay, just temporarily. Oh, that was a horrible idea. You know what? Forget it. I'm trying to be fancy. You're just gonna have to remember what I'm doing. This is transaction, this is adjustment, post-transaction. Just remember that. I'm gonna scroll down. You can't see it now. And I'm gonna take, on the right side, I have this is the adjustment. Okay, I'm getting rid of this old equity. It's gone. Okay. If this is an M&A deal, or sorry, what am I saying? Actually, yeah, even if it's the M&A deal, you would get rid of this because you're like the old owner, they don't own it. So their old equity is gone. That represents the old ownership. We have a new owner in town, and it's from the source and uses, it's the Elon Musk equity. His equity is worth 33 million, which is basically the 44 million plus the fees, less the debt that he financed. So this is like the money that he had to put in, and he had to sell a lot of Twitter stock to do that, of course. And in the end, if we just add up the old one with the adjustments we just made, the new equity is going to be a lot higher, 32.7 million, which is normal. First of all, Elon did not exactly buy at the bottom. But second of all, that's very normal because the accounting value of the equity is usually quite understated because it's listed at the book value of the investments, which is when the investment was originally made, not accounting for any increase in price share price. Anyway, not necessarily if you know that, but now you do. What's the next step? Debt, right? Whether the debt's obviously important. So we got to take out this old debt. Goodbye. You're gone. Now, in an M&A deal where you're combining two strategic companies, like, you know, I don't know, Microsoft buys Activision, for example, you would keep their debt because the company's still like, you're not going to be like, okay, we're wiping out all your debt. Goodbye. But in a PE deal, you're like, we can get better debt, or we're going to get new debt. We're going to take out your debt. Sorry, the leases would probably stay, but any debt would be gone. So we're wiping that out. And then we're going to add on the new debt. The new debt, from what I can tell, is this guy. Oh yeah, so all this stuff, right? This is why we build the source and uses. So it's we have 4 layers of debt. We're going to have to add that in to this non-current liability section. I know technically the revolver might be like, is it long-term debt? Is it short? Who cares, right? Like in PE, you kind of just like, let's just have the debt in one area, which is kind of why I don't even really subscribe to this whole current versus non-current thing. But I just did it because to save time, so you don't have to like reformat the balance sheet. But we're just going to put it all here, which is totally normal. Technically, the revolver is going to like last for more than a year anyway because it keeps going, so it's probably fine. Okay, so to begin with, zero, of course, right? But we're adding in the new debt. So in from the sources, a whole 13.5 billion of debt, revolver, term loan, this quote unquote bridge loan that's not actually a bridge, and this other bridge loan that's also not actually a bridge. A bridge implies that you will use this loan to then take on new debt, but like who's going to be lending to Elon, right? Like it's basically just the actual debt. Whoops, sorry, I didn't mean to do that. Okay, so they're really just debt, and there's a secured loan and there's an unsecured. The unsecured is like kind of junior and really expensive. So what am I doing here? This column, because you can't really see, because I originally here. This is what I'll do. I'll zoom out a bit. Hopefully it's not too small. So now you can actually see the heading. So this is the post transaction. So for all these, I'm literally just going to add up everything. So it's the original amount, the pre-transaction plus all the adjustments. And you're going to see a lot of them are going to stay the same, but for key items like that debt, it shows equity. You know, we got rid of the old one, add the new one, got rid of the old debt, add the new debt. Boom, we got new debt. This is what the balance sheet looks like post-transaction. So we've done the equity part, we've done the debt part. Okay, so notice some of this is wrong. I'm not going to wipe out the non-current liabilities. I actually am going to wipe out the deferred tax liability, and that's because in any M&A or LBO deal, you wipe out their deferred tax assets and deferred tax liabilities. This line just kind of represents money that is either owed to the government or that they overpaid in their taxes. It's sort of a complex concept. I would summarize it as adjusting for accounting mumbo jumbo that's run. By accounting mumbo jumbo, I mean the tax that you state in your income statement is actually either overstated or understated to what you actually paid to your government, because financial accounting rules are different than tax accounting rules. And so the tax asset represents you adjusting for the fact that, for example, that in your financial statements that you show to your investors, your tax is actually overstated. So therefore you've overpaid, and so you're going to get this money back over time. It's kind of hard to explain, but it's just like basically there's a discrepancy between your financial accounting and your tax accounting, and an asset means that your financial accounting like has a higher tax than it should be, and so you build an asset to represent the money that should come back to you, or because you overstated it, and vice versa, liabilities. But the point is, in the M deal, we wipe it out because that's history, right? We don't care about that anymore. So sometimes these are also created when you have like PP&E write-ups that the government will not accept, but you will put in your financial statements, and then you just end up like in your cash flow statement, you end up just reversing it and then creating an asset or a liability to offset that like reversal. So in the end, you still pay the tax in your cash flow statement, but because of double entry accounting, you have to balance it with some kind of asset liability whenever you have a random item in your cash flow statement. And that's what the deferred tax asset, deferred tax liability is. I'll explain that later. I just don't want to get too distracted, but the point is we wipe it out. Maybe I'll explain it with better detail if we have time. But for now, let's just say those are gone. Okay, so they're gone. And then what's the other thing we have to adjust? We've done equity, liabilities. Well, we also have financing fees that we're capitalizing, right? So let's put those in. Whenever I insert a row, I got to make sure like everything actually sums up properly. It's kind of annoying. One of the most common mistakes is like when you see, I just did it there. It's when you insert something, Excel's like, oh, you just want to sum up like the thing that you were like, oh, what the heck? If your balance sheet doesn't balance, by the way, the first thing you do is make sure your sum formulas work. It's actually so easy to mess these up. It's like very, very easy. Okay. So, and I'm just going to double check all of them. Yeah. See, like, because I inserted a bunch of rows there, right? So it's not going to sum properly. These are summing fine. Okay. Cool. So what have we done? We've taken out old equity, new equity, taken out old debt, put a new debt. We've taken out the old tax assets and liabilities. Okay, so and we're now going to do the financing fees. So financing fees in our sources and uses on the left side here, 313. Easy enough. We're capitalizing those. Why? Because these financing fees technically are paid over the um like lifetime of the debt. So we're gonna assume that before I assumed 5 years, right? So we capitalize it because it's like we're saying this is an expense, but technically it's for the debt, and the debt has a lifetime of 5 years, just like your PP&E might have a lifetime of 10 years. So we're gonna spread it out, we're gonna amortize it, just like we might amortize PP&E over time. So it becomes an asset that will get reduced as we add in the amortization every year. And so effectively what we're doing is we're spreading out the expense over 5 years and reducing our taxes over those 5 years by that amortization amount. It gets capitalized, long story short. I do have a question in the YouTube chat from Manny Mason. I'm just going to read. Hi, thanks for today's live stream. Can I ask what are some of the qualities you think are most in demand right now for finance professionals? All the best. Well, one is financial modeling, which we're doing right now. But honestly, I would just a quick 10-second answer for that is knowing your financial statements really well. So like what we're doing right now, income statement, cash flow, balance sheet, knowing how to build models. I would say knowing valuation, DCF, comps, comparable analysis. An LBO modeling is great if you're doing like PE or investment banking. Same with accretion, dilution, merger modeling. But at the very basic, being able to just build a company model is very helpful. I would say financial modeling is by far the most valuable skill in finance, which unfortunately they rarely fully teach in school. So you have to rely on people like me teaching at you in a random video. That is the way it is right now. Maybe it'll change one day. Maybe I'll get a professor one day. Hope Harvard is watching. No, just kidding. I would need a PhD for that, which is, I think somebody who I won't mention my name is getting a PhD who may be watching right now. Okay, so back to this financing fees. So we've added those in. What are we gonna do next? We got to figure out what our cash is going to change by. So we had $6 million of cash in this deal. There are kind of two ways to do this. With a public deal, what you normally do is you say that your cash is actually a source of a source you can use. So you can say cash and balance sheet, and then you will have a minimum cash balance. Now, I'm not really sure what Elon said with the cash, because basically when you buy a public company, you own the entire company, including everything in their balance sheet, including their cash. So it's like, haha, this 6 billion is mine. Thanks to the 6 billion. What are you gonna do with that 6 billion? You could just keep it there. You could also use part of the 6 billion to help finance the deal. If we look at historically, it's been around like this level anyway. It's also a fair assumption to assume that the minimum cash balance they want to keep is like around 6 billion. Now, one way to figure out the minimum cash balance is just look at your operating expenses and just say to yourself, what is like I need enough. It's like kind of when you're budgeting, right? You're like, oh no, if I lose my job, everything goes wrong. Like I need money to cover half my year expenses. So half of your expenses are like what? 3.5 billion, 1.7 billion. Like technically the minimum cash balance could be like as low as 2, but this is also a company that has historically had more cash than that. So we can make a minimum cash balance. So I want to show you how to do that. Let's say it's a full year of expenses, because I feel like half year, maybe for a company like this, that's kind of, more volatile. So full year expenses 3.5. Why don't we round it up to 4, right? That's pretty reasonable. 4 is what they had a long time ago. So, let's say Elon wants to use some of that cash to help finance the deal. So we're going to have to fund this 4 million, but we can use the 6 million that we already have help fund that 4 million. So long story short, there's about I keep saying million, but billion is what I really meant. So there's about 2 billion that we can end up using. So what's this going to look like here? And notice that adjusts like the amount of equity we need too, because I'm getting like, oh, sorry, no, it doesn't, because I need to subtract this. But once I subtract that, our equity required actually goes down a bit. Should have gone down in total by about 2 billion if all this is working right, which it obviously is. I would never make a mistake. Okay. So what does this look like in the balance sheet? Well, basically, I'm going to say, okay, goodbye cash. That is going to be used to help finance the deal. Thank you very much for the 6 billion. But we also need to keep 4 billion on the balance sheet because I kind of decided that maybe 1 year of operating expenses plus a little extra is reasonable. So that's our new cash. You could also just keep it the same, right? We could literally just make this so it doesn't change, but I kind of wanted to show you how it's done if you were to do it. Okay, so what is this? Oh, this is not the right formula. I was kind of confused by this. Are these the right formula? Oh, yeah, that's fine. This is fine. This is fine. Just do a quick formula check. The balance sheet's better to be careful because when your balance sheet doesn't balance, it's usually vaguely stressful. And by vaguely, I mean sometimes very. Okay, so our balance sheet doesn't balance in the post-transaction, but that is perfectly normal because we just like think of this as a scale, right? Normally the scale balances. But we just added like a bunch of rocks on the liabilities and shareholders' equity side. That's the money side, right? Where's the money coming from? Okay, we just added a bunch of money, specifically 14 billion plus change on the fees of money. So that's going to go up by a bunch. If I add up all these, right, it's like a bunch of money. It's not going to be exactly 44 billion actually, but it's because we're also subtracting some things as well, right? But if I added this side, yeah, it's like 40 almost 44 billion. A little less because we're using some of the cash on the balance sheet to help finance the deal in this case. Okay, so which I don't know of real life if he did or not, but I'm just going to give him the benefit of the doubt. Okay, so what does that mean though? That means if we're adding a bunch of stuff here on this side, the asset side is not going to get adjusted as much, right? All we did here is add some financing fees and stuff like that. Like, so we got to find out the difference. Like, what is the difference between the adjustments I made to the shareholders' equity? So adjustments to shareholders' equity. And adjustments to the assets. And sorry, when I mean shareholders' equity, I also mean liabilities as well. Which is, it's a long one. But yeah, that's what that is. Okay, so let's full screen this for a second. Let's just add up those adjustments. So when I'm adding up the adjustments, I want to make sure, oh, there's one thing we forgot to do actually. So we also have to wipe out their existing goodwill. So I forgot to do that. So typically the things you wipe out are the goodwill as well, the deferred tax asset, deferred tax liabilities. You wipe out their original cash and you add on the new minimum cash. You wipe out their old debt. You wipe out their old shareholders' equity. So just to review. Okay, so now that we have that, I can figure out the total adjustments. So on the liabilities of the shareholders' equity side, we basically have like nothing happening to current assets, which is normal because they don't have any short-term debt, right? These are all just like random stuff that isn't going to change. We're not going to wipe out income taxes payable, which is different than deferred tax liability because that's money they actually owe to the government. It's not just like an accounting thing. And then we're going to add up these adjustments to the debt and then these adjustments to the equity. So those are our total adjustments to shareholders' equity and liabilities. Adjustments to assets. Let's add everything up. Now you got to be careful here. You don't want to add up anything that could be adjusted. I'm actually going to avoid PP&E because sometimes that gets written up in an LBO. If we have time, I can show you how that's done, but I'm actually not going to touch this goodwill one because this is like the output. So I don't want to be double counting the output of my calculation. It's going to make the whole thing circular, but I do want to include the write down of goodwill here. And I do want to, and actually, sorry, I just realized the mistake I made. Technically, to calculate goodwill, this is more of an accounting thing, but I do want to mention is you're not supposed to add in the deferred tax liabilities into the excess purchase price if you were writing up PP&E. So right now we're not. So let's just keep doing it this way. But I'm saying if we were, we would. If I have time, I'll show you. But we're actually supposed to not include the deferred tax liabilities in the excess purchase price, which is then allocated. But because we're not going to write up PP&E, I don't have to worry about that. Once again, I'll show you that later if we have time. I don't want to include PP&E actually, even though nothing's happening. Just okay, cool. So adjustment to assets, adjustment to shareholders' equity liabilities. Let's find the difference between the two. So the difference, this is going to be our excess purchase price, which in this case is just goodwill because we're putting it all to goodwill. And sometimes they will get you to put a portion of that to PP&E write up. but we're not going to do that, and that because that's a whole other thing that is a bit more complicated. Okay, so here's goodwill, and let's see if it bounces. It does. That's a good sign, right? So that is how you do a balance sheet adjustment, assuming no write-up of PP&E. Okay, so all that work, what was that for? That was just to get this balance sheet. So this is going to be the new balance sheet now. It's going to be based on the post transaction. I highly recommend that you break it down to steps, or else it's really easy to make mistakes. So, but some people will like just do this in like one cell, and I think they're just crazy because it's like either you're a math wizard or you're going to make a mistake. Me personally, I'm not a math wizard, despite all similarities to being one, but I am not a math wizard. I can only add, subtract. Sometimes I can multiply. Sometimes I can even divide. Okay, so let me just double check. Oh, this should be equal to this as well. Great, so we're all balanced. Good sign. And then we're going to forecast it in the future. So we've now adjusted the balance sheet. So the next step is to do the debt schedule. Conscious of time, I know his original game plan was to do this in 2 sessions, but we'll see. I am going to stop at 2:30, but so we'll see how far we get. But if we end up having to do a 3rd session that's a bit shorter, we will. To be fair, I'm also like just talking a lot, and if I like maybe race through this, I could have, but I didn't really do that because, you know, it's not my style. I like to educate and entertain, maybe mostly just educate. Okay, so debt schedule. How does the debt schedule work? The debt schedule is basically saying, I'm going to start with my free cash flow, right? So what's my free cash flow? My free cash flow is from the cash flow statement, right? Which is why we built this. It's this line here. And I only need it for the years that we actually buy the company. So years 1 to 5. So here it is. It's of course negative. And this is even before we put in the interest. So not looking good. Not looking good. How are you going to, how will they actually pay the interest? We'll see. Now, we're also going to have to add in some other adjustments because this is the free cash flow we have, but it may not be the cash available. The cash available is going to be influenced by a few things. Do we have mandatory amortization on any of these? I don't think we do, but normally you would, right? Like, let me just look at the Twitter thread that helped inspire all of this. It's a Twitter thread about Twitter, specifically about their debt. Do I see anything about amortization? Amortization or mandatory repayment is just repayments that they have to make no matter what. I don't see anything about it though. But normally a term loan would have a mandatory amortization. So I wish they put in that info here. Let me just quickly look. Term loan, Twitter, mandatory. And the reason this actually does kind of matter because if you do not pay your mandatory repayment, you will technically default. So it's like a mortgage payment where part of it's interest, the other part is principal. But maybe there is no. Okay, if there is none, there is none. But if there were, you would just subtract it here, basically. So we'll just make it 0 for now, but maybe when I'm finishing this up, the next session, we can just go over like how. I think the next session will be kind of all the you know, the bells and whistles, whereas today we're just maybe try to get to an answer quickly. Free in the next 10 minutes somehow. Okay, free cash. So, and then we're gonna add beginning cash balance because technically they can use whatever cash they have to help pay back the debt, but they need to keep a minimum amount of cash on the balance sheet so they don't like have a negative cash balance, or, you know, nobody's gonna like live or run a business with 0 on their cash balance. And for them, they need a lot more than 0. We decided they need 4 billion, which is a year of operating expenses plus a little extra of total expenses. And the beginning cash balance, this number is not going to make sense yet. So, but I will link it here. It's just going to be 0 yet for now, but it's just like, it'll obviously not be 0 when I update it. This will be a negative. So I mean, we can link their cash balance if you want. So I'll show you how to do that. So in the cash flow finance activities, we're just going to have basically like borrowings / repayments for each line of debt. So the lines of debt are, if I go back to the source and uses, the first lien revolver. Here, let me just copy this. It's like crazy long. Cool. So these are, and then there could be mandatory amortization for the term loan, but I guess it's like 0 right now. And then it would be this would be their cash flow from financing. Okay, so we got their cash flow financing, which is just 0 for now, for the time being. And then if you were to try to figure out their change in cash, it would just be the sum of all 3 sections of, it would be like cash from operations, cash flow from investing, cash flow from financing. I'm just going to sum up the free cash flow and the financing, because technically the free cash flow is the sum of the operating investing anyway. This is just investing. Like they just literally just have one thing. Maybe just for formatting, I'll make that clear. So it's going to be the sum. I may add more things here. I need to check if there's like other items that would be here, but let me make it so it's that. Cool. Okay, so that's a change in cash. They're basically just losing cash, even without accounting for interest. And then beginning cash and ending cash. Their beginning cash in year 1 is just going to be equal to like whatever ending cash you had before, which happens to be 4 billion, because that is the minimum cash balance we decided on. There's actually a high likelihood that the minimum, like he actually didn't use any cash from the company to help finance the deal, because it's perhaps frowned upon or whatever, but then again, he could have. Okay, so this is the ending cash. So this is going to go into so we got the beginning cash now. So this is going to go into my debt schedule in the beginning cash balance. And I think I mislinked that. It should actually be the beginning cash, not the ending cash. So let me relink it to the cash flow statement where it says beginning cash. So it's easier to not make mistakes there. So that's what's happening there. And this is the cash now available for revolver, or I guess what do they call it? The first lien revolver. Cool. So let's add in the first lien revolver. What does that look like? We're going to go beginning of period balance. This is the beginning, how much debt they start with, net borrowings, and end of period. So the beginning period is just how much revolver they started with, which happens to be 0. Good. Now they're going to need to pull on the revolver here. I don't know what the maximum revolver is, but we're not going to worry about that. Let's just assume that Elon doesn't trip his max. Like it's like a line of credit, right? Like you can't just borrow as much as you want. Now, right now, what we're seeing is because every year he's down money, he needs to borrow on the revolver to just get his cash to 0. And that will actually get higher as we go on, because we haven't even put in the interest yet. So that's the revolver. So after we pay the revolver, we got to see how much cash we have left. So if I kind of put this here, revolver, first lien revolver, I can just link this to the actual money that was borrowed. So, and by the way, the formula I used here is minimum of the cash available and the opening balance. So it's, think of it as like, I need to like, if this is like whatever this number is, I need to either borrow that amount if it's negative, or if it's positive, I need to repay that amount. Because so whatever cash comes in here, or cash I got, I can borrow or repay. But let's say this is actually a positive number, 1,000. Well, I can't pay back any debt if I start off with none, right? It starts off as 0. So it's going to take the minimum between the opening balance and the cash available, because like I can't pay back more debt than I have. So whatever number is lower, it will take. And then we're going to add a negative sign in front of it, because it's like basically if this is positive, then we repay, which reduces the debt. If this is negative, then we borrow, which actually increases the debt. So we just flip the sign. But of course, the cash flow is negative. So we just keep borrowing. And after that, we figure out how much cash we've used. And then if there's any cash available for all the rest of the debt, which of course there isn't, because we have, negative cash. So it's not like we actually are making any cash to begin with. So the next tranche is this thing here. And then it's going to be the same thing. I don't know which ones are prepayable, but usually the senior secured is, and senior anything unsecured is probably not prepayable, because it's a higher interest rate. And when people are making good interest, they don't want you to prepay it. These guys are making, it's like by the time you can prepay a high interest junior debt, that's exactly when the lender most doesn't want you to prepay it, because if you can prepay it, that means you could probably pay back the whole thing. They rather you just keep giving them that juicy like 10% plus, 4% SOFR. It's like 14% return, and particularly low risk if you're at the stage that you can prepay it. So long story short, we're not even going to do the unsecured part. This is where it ends, is here. So so we got the term loan. Oh, sorry, I missed the term loan. So actually there should be another step in between, which is the term loan. This is the cash available for the first lien term loan. And then it will be the borrowings for that. And technically, if we have any mandatory amortization for that term loan, oftentimes you were forced to pay a percentage of the principal down for the term loan. So it's like, okay, every year you got to pay 1% of the principal or 5% of the principal. I didn't see anything in the about the mandatory amortization. So right now we're assuming it's 0, but if it wasn't, then we'd have to make sure that it's accounted for here. And actually, we don't. Sorry, we don't, because it's already accounted for here. So we've already accounted for this mandatory amortization up here. So we just need to account for that. So, and then that would kind of just be, that would kind of be it. We, this would be the last sort of step of the waterfall. So, okay, we only have a few more minutes, but I'm just going to just see how much I can get done in that time. And let's calculate the interest expense here, interest rate, interest expense. It would be nice to see if I can, get this debt schedule done. I probably spend a little too much time talking about net working capital, which is like not the most exciting topic in the world, but okay, so interest rate, let's assume average balance for this. So I can just create another thing called average balance here, which is going to be the average of the ending and beginning balance. Let's save this up so it doesn't ref out. So we already calculated the interest rate, fortunately, before. It was a spread of 4.5% over SOFR, which is as follows, a 4.5% spread. So it's just going to be the average balance here times the interest rate. I'm going to make this negative to represent the fact that it's an expense. Okay, so not too bad for the revolver, but you're going to see that it's where the other debt kicks in. It's going to get a little juicier. Normally you would have mandatory amortization here. Right now we're assuming it's 0, but and the beginning period is from the sources and uses. We borrowing 6.5 billion. So let's create this quick schedule here. And the borrowings is going to be the same formula. The minimum of the cash available this time for the term loan, which is 0, and the beginning balance. We cannot pay back more than the beginning balance. So we have to do this minimum formula. And it's a negative because we only pay back debt if we have positive cash flow. Technically, you can't really borrow, but I'm just using a shortcut here. We're going to make NAND amortization to 0. Let's make it equal to this. And of course, no debt is paid back. So the average balance ends up just being equal to like the original amount. The interest rate on the term loan, and we are down to our last minute here. I think folks, you guys have a meeting after, right, or something. So I'll try to we'll end on the dot here, but and we'll finish it up for next time. But you kind of see what I'm doing here. I'm basically just taking in the interest rate and multiplying it by the average balance, and that's more interest. So another 600 mil. It's getting pretty juicy, and we can add another line for the remaining amount. So I got exactly 1 more minute. I'm just hoping. We'll see. We'll see. So the beginning of the period this time is going to be, once again, sources uses. It will be this amount, the 3,000. Okay, so we're at time now.